In the last video we talked about how important it is to put our money in the mechanism of economy through the investment in the financial market. We also said that stocks are one of the instruments we can use to do so. Let's see in this video then what stocks are and how the stock market works. Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. Stocks are probably one of the most known and maybe even one of the scariest financial instruments. I bet you certainly heard of that friend who got advised by a consultant to invest his money in a bank's stock, and after a couple of years the bank failed and made your friend lose all of his money. Unfortunately, stocks are more complicated than this, and knowing stocks is essential not to be scared and to know what we're talking about when we communicate with experts in the field, such as bankers and consultants. Every company in this world has one and only one goal for his existence: to make earnings. If a company will never make money, it's certainly gonna fail at some point. For this reason, companies need to grow. If a company stays behind in the growth, it will be just a matter of time till it starts to have negative earnings and finally fail. When a company wants to grow but doesn't have enough money to do it, has to find other sources or ways to finance itself. The company could ask loans to the bank, but these are expensive. Another way then is to collect capital from external investors. To collect capital through investors, the company has to sell something. Nobody gives away their money just like that. So the company decides to sell itself. And it does this by splitting itself in little pieces. These little pieces are called shares. These are indeed pieces of paper, nowadays computerized, which certify that the owner of these pieces of paper, so the shareholder, owns a certain percentage of the company. At this point, the company has mainly two ways to sell its shares. The first way is to sell them privately. The company will find by itself investors that are willing to buy its shares. Normally, this is done because the company wants to reserve the shares only to a select group of people, and more importantly to people that have a substantial amount of money to invest. The second option, the one that is probably the most known, is to distribute the shares to the public, so to everyone that can afford to buy at least one single share, so at least one little piece of the company. The trade of these shares is done through the so-called stock market. To do this, the company has to be available on the stock market. This is done through the so-called stock exchange listing. A stock exchange represents a portion of the total world stock market. Normally, we have stock exchanges in every country, and usually on that stock exchange we will be able to buy shares of companies from that country. Indeed, on the New York Stock Exchange or the Nasdaq, we will mainly find shares of US companies. But how can a company get listed on a stock exchange? Well, first of all, it has to fill a lot of paperwork to attest that it respects all the requirements to be allowed to enter in the stock exchange. But more importantly, it will have to decide how to get listed. There are mainly two ways to do so. The first way is to list directly. The company will decide how many shares to put on the market, so how many little pieces to sell, and once these are on the market, they will be bought and sold by investors at a price of their choice. Or to better say it, the price will be defined by the laws of supply and demand, which we will talk more about in later videos. Of course, in this case, in the first period of trading, the price will be mainly dictated by the company itself. This is because at first the company is the only one who owns the shares. The second way is to first sell the shares through an initial public offering, an IPO. In this process, there will be some experts, normally financial institutions, which will decide which is the most suitable price for the shares of that company. Once the price is decided, the shares will be distributed through various banks, which will sell the shares to the individual investors, to us basically. Once the initial public offering is finished and all the shares that the company wanted to sell are sold, these will be available on the stock market and everyone will be able to buy the shares on the stock exchange that the company chose. So let's make an example to understand the whole process. Let's say I'm a random company, let's call it Dario Inc. or Dario AG for the Swiss friends. Let's say I divide my company in 500,000 shares and I would like to put on the market some of these shares, so some of little pieces of my company. And I want to do this through an initial public offer. What I need to do is contact some financial institutions. This will help me decide how many shares to sell and at which price. Once the amount has been decided, let's say 250,000, and the price, let's say $100 as well, the financial institutions, so the banks, will resell my shares to the investors. Investors will then come from everywhere, from New York, Los Angeles, Dallas, and so on. These investors will buy my 250,000 shares at a total price of $25 million. So, at the end of the IPO, I will have collected $25 million. At this point, the shares will be available on the New York Stock Exchange. This is because the company was from the US. If the company instead was Swiss, it would have been probably available on the Swiss Stock Exchange. And now what happens? Why do the prices of the shares go up and down if there is no more Dario Inc. that wants to sell? Every day, on any stock exchange in the world, thousands of shares are sold and bought, and these are bought and sold by investors between investors. And so, how can the company earn money if it doesn't sell shares anymore? It doesn't earn money, simple. The goal of the company was to collect that first $25 million. Nonetheless, we said that not all the shares have been put on the market. The company can therefore put more shares on the market and collect more money. The company has indeed 250,000 shares more. But if I invest in a company and so I buy the company's shares on the stock market, what will I earn? When we invest in a company, we will make money in two different ways. The first way is through the so-called dividend. When a company at the end of the year brings home a certain amount of earnings, it can choose to give a portion of it to its investors through dividends. We will talk about dividends in later videos, so if you don't want to miss it, I'll suggest you subscribe to the channel. The other way is through the growth of the value of the company. I'm not talking about the growth of the price on the stock market. This is indeed a consequence of the real value of the company. The company has the so-called net worth. Actually, we all have a net worth, and it's fairly easy to calculate. But this will again be subject of another video. In any case, when we buy a share, we are actually buying a piece of that net worth. We can pay it more or less in respect to its value, but we are still buying that. If the company will perform well, the net worth of the company will grow, and consequentially the price will grow probably as well. This is because people will be more and more interested in buying the stock. We will then have the chance to sell our shares and gain a tangible profit from the growth of the company, which is practically intangible. We cannot ask a piece of net worth to bring home. The most important thing that I would like to share when we buy stocks on the stock market though, is that we are not giving money to the company. This happens only at the beginning and in other rare occasions. The money is given to another investor who, opposite to us, decides to sell its shares. He doesn't want them anymore, and so he sells them to us because we want to buy them. If the interest towards the company is high, people will be willing to pay more and more to buy a piece of the company, and so the price of the shares will raise. On the contrary, if the interest towards the company decreases and it's very low, and maybe the company is doing bad, people will be willing to sell their shares at a lower and lower price just to take home the remaining amount of money, and so the price of the shares will drop. Owning shares is the method by which the most successful businessmen, as for example Jeff Bezos, the owner of Amazon, have become rich. Every company, Inc., CO, SA, AG, SPA, and so on, either if it's listed on the stock market or not, is divided in shares. These are entirely owned by the owners of the company if this has not been yet listed on the stock market exchange. The moment the company distributes a portion of their shares to the public, as we said, this will grow in price if the company will perform well. and the shares that the owners initially owned at a very low price, equal to practically the initial investment, will now be worth hundreds of dollars, exactly like Amazon shares. To understand the concept, let's think about Jeff Bezos, who received in 2018 a paycheck of around $1.7 million. On the other side, though, Mr. Bezos owns a 16% of Amazon shares, which have a total value of $125 billion. We are talking about a value which is 73,000 times bigger than his 2018 paycheck. To make it even more clear, if we say that Bezos' paycheck was always $1.7 million for the entire existence of Amazon, so around 24 years, his profit would be of $42.5 million, not even near to the total value of the shares he owns. Of course, not everything is nice as the story of Amazon. We cannot predict which company born today will be the next Amazon in 24 years. Therefore, we have to invest in many companies to lower the risk and increase the probabilities of success, even though this will be a little bit lowered as well. To do this, we have some instruments that can help us. These are, for example, funds or ETFs, which we will talk about in the next video. So, if you don't want to miss out on any further video, I highly suggest you subscribe to the channel immediately so that you can be notified on any new release. Lastly, if you enjoyed the video, please leave it a like. This is one of the few ways that I have to see if you like the videos and therefore keep posting. Nonetheless, I will see you in the next video.